Hello and welcome to another edition of Value Investing Decoded. The guest on my show today is Sankaran Narain, who's the Chief Investment Officer with ICICI Prudential AMC. Now, all the people that I've interviewed on this series or people that I've spoken to get inputs, ideas, have all told me one thing. You must get and talk to Narain. You must feature Narain on this program. Narain is with me right now. Thanks very much. Great to have you here. Very high praise for you, Narain, from your peers in the investment business.
Oh, thank you. But, actually, as a fund manager in 2007, value investing was a discredited idea.
Right.
And maybe some of the colleagues in the industry know how much I had to handle the stresses of 2007. And that's been the reward.
But you stuck on, so maybe that's why they appreciate what you do greatly as well. But, I'm just wondering, value investing isn't, I mean, I was having this discussion with my colleague, isn't all investing value investing at the end of the day?
Yeah, that's what Warren Buffett says. He says value investing is joined at the hip with growth investing.
Right.
But what makes value investing special is because you're buying low and selling high.
Right.
And that task, when you any asset class, when you buy low, you're not with others.
Right.
And when you're trying to sell high, again you're not with others.
Right.
Because the reason an asset class is low or high
Right.
is because of the kind of supply demand in that particular asset class. So I think the fact that value investing involves being not with everyone,
Contrarian in that sense.
it becomes contrary.
And that is opposed to growth investing, which does what? Which pays any price for where there is growth visibility.
So in growth investing, you actually buy when things are good and hope that they remain good.
Okay.
And very often trends tend to last quite some time. So what happens is you're not isolated at the time of buying.
You're with the crowd.
You're with the crowd, so
Right.
to speak.
Okay. You made it sound very simple. Value investing is buying low, selling high, right? But it's not simple. Easier said than done. I'm going to ask you to break it down for our viewers. What should they look at when they talk about value investing or think about value investing? This is what I want to do. The idea is great, but how to go about doing it?
See, from the point of view of a mutual fund investor, if he practices asset allocation, he is actually practicing value investing.
Sure.
Why? Because if you practice asset allocation, what you would have done is sell equities or redeem from equity mutual funds in 2007. And when the crisis broke out in 2008, you would have bought equities.
Okay.
Or invested in equity mutual funds, or in 2013 as the markets tanked,
Yeah, you could have
invest
bought
in
late
equities.
2013. Yes.
Yeah. So I would say that if you practice asset allocation, you're essentially what you're doing in practicing asset allocation is you're buying low and selling high, which is value investing. So I would say practicing asset allocation is the simplest way any mutual fund investor can practice value investing.
How do you do it? What is your way of doing it?
See, I'm not an asset allocator. I'm a mutual fund manager.
Sure.
So as a mutual fund manager, people allocate money to us, give us money to manage. Then we actually try to buy what is cheap and what is low. And what is cheap is relative to a sense of value and then buy at that point of time. So now what is cheap at a point of time keeps changing. So today if you go and take metals or select oil and gas stocks, they were extremely expensive in 2007-8. They're extremely cheap now. Now that makes it very clear that today if you are value oriented, you would look for some metal stock or oil and gas stock to look at. Whereas if you go to 2007, consumer stocks were very cheap. Pharmaceutical stocks were very cheap. So at that point of time in 2007, consumer pharmaceutical stocks were cheap. That means they were quoted much below their intrinsic value.
Sure.
Whereas today, most of the consumer stocks or most of the pharmaceutical stocks are costly.
Sure.
And they possibly are not cheap against their intrinsic value as of today.
Sure.
So consequently, that's what value investing is about.
Sure. But how important is how do you assess what is the right price to pay? How do you assess the business first? Because I'm sure that it's not just quantitative, right? I mean, this is the historical 10-year average at which the stock has been trading. It's available at this. It's very cheap. So let's buy it. I'm sure it's not as simple as that.
See, it isn't. There is a very famous global value investor called Seth Klarman.
Right.
He calls value investing is contrarian with a calculator.
Sure.
So what happens is that you have to have a calculator. Now in that calculator, you have to have a base idea of what the company is worth.
Sure.
You use simple techniques to buy it. If it is too complex, it means it cannot be calculated.
Sure.
And then contrarian is very easy because you know where people are not interested at a point of time,
Right.
and you know where people are very interested at a point of time.
Right.
So I would say you follow that framework, you get an idea of what is value investing.
So you are looking at running a screen essentially, and then arriving at businesses which are trading much cheaper relative to historical valuations, and then you go company by company. Of course, the business is important as well.
Yeah, absolutely. I think screens clearly help you to identify what has fallen, what is cheap, what people are not interested in,
Okay.
or on the other side, what is costly, what all the people are interested in, what has gone up substantially. So on both extremes, screens help you to give you that starting point. And then after that, it is a matter of looking at it deeply, look at the annual report, look at the history of the company. You will get a fair idea of what is value.
Naren, but in broader market panics, everything becomes cheap, right? I mean, relative to where they were trading earlier. But in a strong market like the one we are in right now, in a bullish phase, if something is not really the market is not appreciating something, a business, it's trading very cheap. Isn't usually there a reason for it? So it might show up on the screen as being very cheap, but shouldn't it remain cheap?
There will always be a reason for it, and that reason is where a fund manager comes in. So if you take, for example, you could have bought a company which offers normal phones, fixed line phones, as opposed to mobile phones. Now they were becoming cheaper and cheaper by the day. But the truth was the whole way in which people talk changed. They moved from fixed line to mobile.
Sure.
So in that kind of a situation, if you had bought a fixed line telephone company in India, you would have lost money.
Sure.
So there, it is not just cheap,
Right.
but it is like it is something where value got destroyed. On the other hand, if you look at, for example, many of the things, there will be periods of panic. And in those periods of panic, when you buy, you normally make very good money because this panics doesn't always last.
Yeah.
So in 2008, you had panic.
Yeah.
In 2013, currency in India, you had panic.
Yeah.
If you look at it recently, you've had panic in Russian currency. You're currently having a panic in Brazilian currency. So you have periods where you'll have panic. So it's in any value investor normally buys during times of panic. And that is the key test of a value investor.
Okay.
So if during a period of panic, if you're going to try to run away, then you're not doing value investing.
How do you assess the quality of a business? For our viewers, just explain it very simply. What do you like to own? What are the thresholds that it needs to meet?
See, the quality of a business from the point of view of a viewer who has is like, if you have been using toothpaste over a long period of time, you continue to likely to use toothpaste. If you're used to using soaps, you're likely to use it. So in goods which are simple,
Which you can touch and feel.
you know that they have all been in existence for a long period of time.
Sure.
On the other hand, from the time when I was studying engineering, our computer was to what it was in the late 90s to the tablets of today, everything has changed.
Yeah.
So those are fast changing industries.
Sure.
So if you're looking at fast changing industries, you have to be much more careful because the way fast changing industries like electronics or computers have changed, it's pretty drastic over the last 20 to 25 years.
Sure.
Whereas you have slow changing industries.
Sure.
So surprisingly, the best investment opportunities are in the slow changing industries. So if you drink a carbonated drink, you would have had a carbonated drink 20 years back or today. So that hasn't changed. So
Warren Buffett
industries,
says if you chew gum now, how you chew is not going to change 100 years from now.
yeah.
Right?
So that's a beauty.
But those are touch and feel kind of businesses, and those are still relevant, right? Those are still very much relevant. But people who can assess businesses a little more objectively, who are a little more skillful than first timers or beginners, what would your advice be to them if they really want to do it on their own and not hand over money to a fund manager?
See, then they would have to do a little bit more work. But in essence, if you open a newspaper and you would get an idea of where there is mania and where there is panic. And it is not every day you will have mania and panic.
Yeah.
So if you continuously read the first page of a newspaper over a period of time, you will know periodically once in 4-5 years you will have mania or panic. So the essential investment would be that during that panic, which will show up in the first page of a newspaper, you buy.
Yeah.
And if you see mania, at that point of time, you have to get hold of the greed part of it and actually try to sell.
I had a friend who used to say that when you see markets making headlines on the front page of the Times of India, it's usually the peak. I don't know
both ways.
both ways.
So if you had seen the newspaper on the day after Lemon,
yeah,
that would have also made the first page of newspaper. So I would say actually a general purpose newspaper, the first page,
yeah,
if you start getting market data,
sure,
it would either reflect panic,
yeah,
or mania.
Yeah.
And in my opinion, if you see, if you can only participate in those days, that is enough, because periodically once in 10 years, you always get mania and panic. So if you opt to invest in panic and sell in mania, you made it. And you can afford to, as Warren Buffett says, you can afford to do everything else in those balanced days. As long as you know to buy in panic and sell in mania, you're through.